Well, hello everyone. This is Gene Trowbridge, and I'm talking to you today for another episode of TLG Talks. And today I'm happy to have with me Amanda Hahn and Matt McFarland. Amanda and Matt have been known to me, and I've been known to them through a client and friend basis for many years, many years. In fact, right now, Matt and Amanda are doing the accounting for our law firm and have done a lot of work for us, and we refer them to many of our syndication clients. And as TLG Talks goes along, all we're trying to do is we're trying to talk to people in the syndication world, syndicators, people who provide services to the syndication world, and we do these and we put them on our YouTube channel. I want everyone to go to the YouTube channel and subscribe. And we have a lot of great interviews that we're going to do. So without further ado, let me turn it over to Matt and Amanda, and you can tell us all how you guys got started and tell me about your family and all that stuff. It's cool.
all that good stuff.
Yeah.
Well, I, in addition to you being a client of ours, I can happily say that I think we were a client of yours at some. I think I attended at least one of your sponsorship workshops at some point in time. So,
well, I think so.
I can say that I've done that. So,
Yeah.
no, we're a husband and wife.
It wasn't so good because you only attended one, right?
it's just a CPA practice, is the daily life bread, right? So, but yeah, we're a husband and wife team. We've been having our own practice for, God knows, 12, 13 years now. We specialize in real estate investors. I'd say 80 or 90% of our clients are real estate investors. Some on the more active side, the syndicators, the sponsors, wholesale, fix and flip. Some on the passive side, where they have the W-2 job and invest passively.
Yeah. In addition to that, Matt and I are both investors ourselves. So we do enjoy working with clients and kind of seeing what kind of deals they're doing that makes sense. And for some of our clients who are syndicators, we have the opportunity to, get some unique insights into those deals and also see if that makes sense for our portfolio. But yeah, before having our firm, both of us worked at one of the big four public accounting firms back in the day. In the real estate specialty group. So that's kind of where we got our feet wet or got started in the area of real estate tax planning. And that's kind of our passion. We do have a passion, just like you, Gene, I think in education, in helping to teach investors the right things to do to really maximize their tax savings through real estate. And we all know there's a lot of tax benefits, of course, to real estate investing.
And we follow each other around on the speaking circuit. We can name any number of people who've invited us and had us. And I interviewed Karen Hall, and I'm interviewing you, and you're doing all this. So it's kind of fun. I don't know if I knew you when I was a syndicator. I think that was too long ago. But certainly I've known you. I became an attorney in '95. So I've probably known you almost all of my attorney life. As I tell everyone, in '95, I left the syndication business because the care and maintenance of partners became overwhelming. And I thought for the last 15 years of my life, I'd go to law school and I'd be a syndication attorney. Well, that was 27 years ago. So so we're still practicing and have good practice. And I know we are lucky enough to have people like you to refer our clients to from all around and appreciate the attention you pay to them. Well, we really have three questions we're going to ask today. First question is, when you work with real estate syndicators, what are three? I think I asked you to identify three issues that you wish they would talk to you about before they bring their offering to the street.
Are they supposed to talk to us before they bring their offering to the street? Is that the implication there?
I think they should, because I know that they don't. I know that my clients don't, and I know other CPAs tell me that their accounting clients don't, and it's too late, right?
Right.
Yeah, I think that's one of the main things. If you're just starting out, maybe like a rookie syndicator, it's extremely important to talk to your CPA before, like you said, the offering is brought out to the street. Typically, we come in working with, your firm, Gene, or someone similar to you, in looking, in getting involved in kind of the whole setup process, right, for the offering, because that's where the planning occurs. On the other hand, if it's someone who has already made the offering to the public, oftentimes it's difficult, if not impossible, to change the structuring and how the income flows and all that. So certainly, I think for newer syndicators, or even experienced ones, it's really as simple as an email or a phone call to your CPA, letting them know what you're planning on doing, because then they can hop on the call with you and your attorney to kind of hash out what are some of the things that we should be looking out for. I think it's important for all types of real estate deals, but extremely important for syndications, because it doesn't involve just you and one or two partners. Potentially involves a lot of investors. And also just, right now we're in an environment where there's a lot of tax changes coming out from Washington on a weekly or monthly basis. So really important to keep that line of communication open, like you said, prior to offering the actual PPM publicly.
I think a couple things that come to my mind is one question would be is to decide before the offering starts is who's going to be doing the financial statements. We come in with clients and help them all from a tax return perspective, but they're going to need somebody doing the actual bookkeeping and financial statements. And along those same lines, hopefully, it's not the client doing that. Now, we have some clients who can do it and understand it, and that's totally fine. But, obviously from a majority of them, they don't have an accounting background. So hopefully they're not the ones doing it. And also it shouldn't just be the property manager doing it. So a lot of times syndicators think, well, I'm getting financial statements from the property manager and that's going to be sufficient. Well, that's sufficient to cover the property, but obviously you've got the entity that has all the investors and it's got its own bank accounts and its own transactions that need to be incorporated into the financial statements. So that's something that should be addressed before the offering starts, so that your ducks in a row, everything's organized before the offering. Because the last thing you want to do is be taking millions of dollars of investor money and not have financial statements in order. The other thing I think that comes to my mind is something Amanda alluded to, is just deciding before the offering, obviously even before the offering is even written up, is how do you want to allocate profits, losses, distributions? Because we were joking earlier, right? Is sometimes we don't find out about a client's syndication until tax return time, and it's like, well, when we're doing the tax return, they haven't told us ahead of time. We're looking at an operating agreement, for example, and how we need to allocate things in the tax return may not jive with how they're expecting it to happen, and you want to have that conversation way ahead of time before you start bringing investor money in the door, so that you can change it as you want to. And I think sometimes people think that when doing allocations or how we want to allocate profits, they think more complicated is better. And so my opinion on that is more complicated is not necessarily better, and it's definitely not always necessary either. Especially if you're new to this field or syndicating things, probably want to keep it simple so that you can be able to explain it to an investor in 30 seconds when they ask you the question.
One of the things that I've found during this tax season, and we're still probably in it for a lot of people, I know myself I am, is that investors don't always understand, and I don't think the syndicators always understand, the ability to use losses. I probably had a dozen calls in the last 2 months from my clients who are the syndicators who say, my investors are calling me and they're saying that we passed all these losses. We did cost segregation and we passed all these losses to them and they can't use them. What's going on? Well, welcome to the passive loss world, or passive loss rules and all that stuff. And I think it's interesting. In fact, I did a 3-part series for my YouTube channel. One is depreciation, understanding what does depreciation really shelter, it shelters the income from the property first.
Right.
Maybe there are other losses that can pass through to the investor, but then we better talk about the passive loss rules, right? And then we better talk about the capital account. So those are things that I think that syndicators should be educated on that. And I think ahead of time, if you're going to make all that, to say nothing of who's going to sign the recourse loan and who gets basis, this is not an easy deal, the easy business we're in when we do these operating agreements and you guys do the accounting. Would you agree with that?
Yeah, definitely. And that's why it's so important to get your team together, not just talk to the attorney or just talk to the CPA, but talk to them together and kind of figure out how, like Matt said earlier, how are the income and losses going to be allocated? But you're right. I do see a lot of times when, from a marketing perspective, syndicators, just like a lot of real estate investors, are talking about the tax benefits of real estate investing. So sometimes you might see marketing that says, hey, invest with us. You're going to get X, you might write off 70% of your investment because of cost segregation, bonus depreciation. And like what you're mentioning, yeah, although that's true, it's done at the syndication level, which is great. But it is extremely important to let your investors know that your ability to use that, your timing of when you get to benefit, is going to be unique to every single investor in the syndication. And that's where, for the investors to talk to their CPA beforehand and figure out, am I able to use it? Even though there are passive limitations, one investor might have passive income, which allows them to use it right away. Another might not have any or expect any for a couple of years. So I think it's important to be upfront. I understand for the syndicators, it's not their job to be the CPA or be the attorney and understand all the intricacies, but it is definitely good practice to let them know, hey, here's what we're going to be doing for you, but talk with your CPA about your ability to utilize those benefits, right, or not.
I don't see any offerings, at least not the offerings that I work on, that deal with projections of after-tax returns. Everything is pre-tax, but they do sell the benefits of cost segregation, and they do all that. And I had one investor who actually did call me and said, I was expecting the $300,000 write-off to shelter my W-2 or whatever. And I said, not now, someday maybe, but not.
I think you also hit the nail on the head earlier when you mentioned kind of your past life, right? When you get into the syndication space, people don't realize that they're going into the customer service business, right? As a syndicator, you've got to care and maintenance of the partners. And so, this, like, you could be taking investors $100,000, $200,000 of money, but the one who's always going to be the biggest pain in the butt is the one that's giving you $25,000 or $10,000, right? Like, so they have to realize that they're going into this as, they're providing a service and they got to deal with their customers. And that's part, you want to be, again, you don't have to be the CPA, but you want to, be able to have an educated conversation, obviously.
I just got off of a call with a group of syndicators. And one of the things I said is that you probably will have more trouble in your career with the people than with the real estate. Yeah. And like I said, the care and maintenance of investors drove me out of the business, because back then there were no IMSs, there were no back office companies who did all this work for you. My last year, I sent out 1,687 K1s. My little staff of 4 people were looking stamps and looking envelopes, and we're out of business for 2 months. To say nothing, we had 16 funds, and I was using 3 different accounting firms, because eventually, when I took 10 down to, the guy's name was John, he said, "Oh, Christ, I can't do 10. I got other clients to work with," so we had it spread all out. We were out of business December, January, and February, just doing that stuff. So it's a challenge. So then one of the things that's come up in the last 2 years is this issue of disregarded entities. And tell me about that.
Well, from a tax perspective, a disregarded entity is just like it's like an LLC that somebody creates for asset protection reasons, right? So they're going to invest in a syndication, or, you know, and it could be direct real estate owned too, but instead of owning it in their personal name, they want to, you know, kind of shield themselves. So they create this LLC that is either owned by themselves, or maybe it's owned by husband and wife who live in a community property state. And they use that LLC to then invest in the syndicated fund or to go out and buy their real estate. Now, for tax purposes in those situations, the disregarded entity, it's ignored for income tax purposes.
How come?
It's just the way the letter of law. So it's either because it's 100% owned by one person, or it's 100% owned by a husband and wife who live in a community property state. You then still report the underlying asset or activity on your own personal return.
And they're using their social security number.
A lot of times, yeah. Sometimes they'll get an EIN for the disregarded entity. It kind of depends, but
yeah. So I mean, so basically, disregarded just means it's a legal entity, but for tax purposes, it doesn't file a separate return. It is filed on the return of the owner of that disregarded entity. So like I said, the owner could be a person, a married couple, or even another entity, right? So you have a disregarded LLC owned by another LLC or owned by an S Corp. And one of the newer things that came out in the last couple of years is, you know, before, when you issue K-1s to investors, you would just have to list the name and tax ID of the entity who received the K-1. So if I have Mickey Mouse LLC receiving it, on the K-1, we show Mickey Mouse LLC and their tax ID number. But now the IRS wants to take it a step further, and they said, okay, well, if Mickey Mouse LLC is a disregarded entity, which then means Mickey Mouse LLC is not filing a tax return, I want to know who is owning 100% of Mickey Mouse LLC and what's their tax ID number, so that I can make sure the income or losses are actually reported on that owner's tax return. So that's one area that a lot of syndicators, maybe CPAs, didn't really know about upfront. And so that's when we're seeing, not as much this year, but, you know, a couple of years ago, having to have syndicators go back to the investors and saying, hey, you know, for this disregarded entity, I need to know who the owner is and what the social security or tax ID number is. Sometimes we've seen pushback from the investors like, hey, I've been with you for years. Why are you all of a sudden asking me more kind of, you know, private information?
right. And the syndicator, maybe it's a syndicator who's been doing it for years, and they're pushing back on us like, hey, I've never had asked for this information before. It's like, well,
but doesn't the K-1 now ask you that?
Yeah, it does. And it's, I don't know, I don't remember if it started, might have started 19 returns, but definitely in the last 1 to 2 years for sure.
Yeah. And so what I have seen and I have done now is put a clause in the subscription agreement right after where the investor checks how they're going to take title. We put a little question in there: is this a disregarded entity and whatever? And I'll be damned if they know what that means.
Yeah.
You know, and the syndicator doesn't know, and the investor doesn't know, and they want no. But isn't there a penalty if you don't have that? Is there some sort of a penalty from the CPA side in filing tax returns? If
there probably is. It might be one of those like $50 per partner type of thing. I don't know off the top of my head, but sometimes there is if you don't disclose everything and they, you know, catch it 2 years later and come back and say, hey, you're missing this.
And what a lot of people don't know too, so, you know, in terms of putting in the as a question on the subscription, what a lot of people don't know is an LLC can choose how it wants to pay taxes. So oftentimes we'll see someone say, hey, I'm taking title in Mickey Mouse LLC. Well, the follow-up question is, how does the LLC file tax returns? Is it a disregarded entity? Does it file as a partnership? Maybe it files as a corporation, right? So the LLC could file in all different types of returns. And that's also something that's disclosed on the K-1 as well. So, you know, but like you said, sometimes the investors and the syndicators don't really know the answer to that. And that's where a lot of this upfront work, you know, when you're getting the investor info upfront to get that rather than waiting until tax time is always a good idea. Because I think we all know that, you know, one of the things Matt said earlier is if you're syndicating, you know, newer syndicator, make sure you have financial statements, you have a bookkeeper, because one of the worst things that could happen is at tax time, your CPA is asking for financial statements because they want to do the return and issue K-1s. All you have is a property management report. And so you now have to put together the financials with all the, you know, investor contributions, all the distributions you've paid. And, you know, all the investors are, at least the ones we see, are antsy to get their K1s. You know, starting in February is when the emails start coming, and they ramp up more in March and April. So the sooner you have your financial statements ready, you know, close to the end of the year, the better shape you'll be way before tax time.
I know there's a date for 1099s that have to be distributed. Is there a similar date for K1?
No, the technical distribution date is just actually, you know, it's got to be given to them before the individual files their return, obviously. So, I mean, now partnerships are due March 15th now in a typical year. This is pre-COVID, obviously, but and individuals are due April 15th. So they changed that a couple of years ago so that the partnership would theoretically file by March 15th, and it would give the individual investor 30 days to take that K1, incorporate it into their personal return, and get it filed by April 15th. So.
Yeah, I mean, we do, you know, we also, most of the syndication work that we do, we try to get it done before March 15th, again, because investors are anxious to get K1s. We do have some syndicators that, you know, for one reason or another, they just, there's not enough time to do it, in which case they go on extension. So, you know, even now we're working on a couple syndication returns. So naturally their investors have to go on extension because they can't, I mean, they shouldn't file until they get that K1 showing the, you know, the profit or loss. So,
and that makes an investor really upset if they're expecting a refund.
And that's part of that, you know, that's, to be honest, that's part of the care and maintenance of investors, right? It's communicating up front, because a lot of times the syndicator, you know, in our experience, you know, is not expecting that to have to deal with that aspect of it, but it's all, and it always comes, you know, they want to push back on us like, well, what do I tell them? When's it going to be done? And it's like, well, as we explained to you, it takes us X number of weeks to get the returns done. So you should be, you know, do the math and, you know.
Yeah, I think one of the things with some of our bigger syndication clients that have multiple funds and just, you know, the more complex ones, we try to have quarterly or biannual meetings with them. So we're looking at their financials during the year. And the goal for that is that by December, the books are in fairly good shape to close. And therefore, we'll have the financials in early January and start working the returns, right? So otherwise, if February or March is the first time that the CPA is seeing the financials, and if they're a big mess, then that's where, like Matt said, well, you know, you work backwards and say, okay, it takes you 2 months to finish the financials. And from there, we might take another month to, you know, get the return and issue K1s.
Yeah, that's the truth. That's a challenge. Well, you are an important part of the team. I mean, from a syndication lawyer standpoint, my work is pretty well done when they finish raising the money and they close the property. My fee agreement does cover them for another 6 months in case there's something going on. We need to amend the PPM or the operating agreement, but we're pretty much done. And then you're taking over and you're going to be with them for 7, 8, 9 years. So I would say you're a pretty important part of the team, and that's great. Well, this has been great. You've given us a lot of good information that people who watch our YouTube channel will see, and I appreciate that. So I have one last question. I think I know where it's going to go, but the last question is, what advice would you give to rookie syndicators? If you could meet someone, they came into your office for an interview or something before they did their first deal, what advice would you give them?
I think for me, it is all about, you know, having the right team of advisors. When we have clients who are starting to syndicate, one of the first questions I ask them is, who's going to be your syndication attorney? Because you want to work with someone who specializes in syndication law, not just, you know, my estate attorney who also does syndications on the side. And same for, you know, CPAs too, right? You want to make sure your CPA is someone who is well-versed and has experience with syndication on the real estate side. And the reason those things are so important is because unlike a partnership with just the 2 of us or the 3 of us, the syndications involve so many other people. And so you just want to make sure you're doing everything correctly so that, one, it doesn't come back and haunt you. And two, you're basically building a brand and you want to make sure that you have the best representing you on these different aspects.
Yeah, I mean, I think that hits the nail on the head, to be honest with you.
Well, that's interesting. I've done 37 of these interviews, and 36 times when I ask that question, the answer is the team. This is not a do-it-yourself business. Build a team, surround yourself with people that can help you. And the other person who answered the question echoed a little bit what Amanda said. They said, well, you got to have a brand. Well, how do you have a brand? Well, you have a team that you can say,
Right.
We've identified some opportunities. I've assembled this team to help us take advantage of these opportunities, and therefore you should entrust your money to my team. And when I was doing it with Trowbridge Equity Group, 16 different times, equity group this, equity group that, I branded Trowbridge, and no one does it anymore. No one uses their own name in branding, but when I was doing it, that's all I had to offer was me. And so I started it, and I kept on going, but no one does. No, I mean, you don't even use your own name in the firm. You use Keystone CPAs, not Matt and Amanda CPA. I understand.
Yeah, people think we're in Pennsylvania a lot.
Yeah, isn't that true? Well, Amanda and Matt, thanks very much. There's a picture on the screen with your website, KeystoneCPA.com, and people can go to your website and find your information and get in touch with you. And I'll see you sooner rather than later. Thank you for your time.
Yeah, thanks for having us.
Thanks so much, Gene.